I'm called member for Wright.
Thank you, Mr Speaker. I rise today to speak on tax law amendments, investment manager regime 2012. The bill constitutes the first of two elements of the investment manager regime, and they are broadly designed to address the impact of the application of United States accounting rules, what are referred to as FIN 48, on managed funds investing in or through Australia. These applies to the 2010 and 2011 years and prior. They also exclude from Australians from tax from 2010 and 11 and later income years. Certain income or widely held foreign funds that is taxable only because the funds can be used as an Australian-based agent, managers or service providers. This was directed at foreign income and Australian capital gains, both which would have been otherwise outside the scope of Australians, but for these funds used a local manager, and of course the removal of uncertainty of the tax treatment of conduit income of managed funds. Excuse me, Mr. The amendments ensure that the foreign funds that use Australian intermediaries are not subject to Australian tax on certain income that, in the absence of an Australian intermediary, would otherwise be foreign source of income. This tax treatment will extend to foreign residents, beneficiaries or foreign residents, partners of foreign funds that received or are attributed amounts through one or more interposed trust or partnerships. Australian residents, investors, will not obtain any concessions from this measure, and the tax treatment of any income received from a fund by an Australian resident will remain under this bill broadly unchanged. Where the conditions of amendments are met, certain types of investment incomes and gains will be excluded from Australian tax. In addition, losses or outgoings in respect of certain investments will be disregarded. These amendments will apply to the 2010-11 period and later income years. Deputy Speaker, I'll also mention this bill and its interim step along the path to full investment management regime has not changed significantly since the exposed draft was released. The establishment of an investment manager regime was one of the centrepieces of the Johnson report recommendations on Australia's Financial Centre released back in January 2010. Deputy Speaker, I stand here today because I support the recommendations made by the Johnson's report, and particularly the parts of that report that pertain to this bill, including the establishment of an investor management regime. For the past 18 months, Australian fund managers have continuously told the Australian government that overseas investors will only invest through Australia once legislation has passed Parliament. So it's pleasing to see that this government has finally moved on this and moving towards getting something right. The Johnson report highlighted that the sooner that we act, the sooner we empower our financial services sector to access market growth on our doorstep and establish Australia as a genuine world-class financial service hub. Despite these strengths, the Johnson report observed that the sector could benefit from becoming more export-orientated. So the underlying principles of this bill are fundamentally sound and supported by recommendations in the Johnson's report. One of the key initiatives aimed at making the sector more outward-orientated was the investor manager regime. The establishment of an investor manager regime is strongly supported by Australian financial services industry and the Financial Services Council. The investment manager regime would be particularly beneficial to smaller, specialised and boutique Australian fund managers. In the past, larger fund managers have been able to establish offshore operations in other financial centres such as Luxembourg, Singapore, Hong Kong, to get around these barriers of the Australian tax system. However, this has never been a cost-effective option for smaller yet highly sophisticated and very talented fund managers. These small players would now be able to compete more effectively both against larger locally based competitors and overseas competitors, which would enhance choice and competition in the Australian market. It should be noted that these changes have been the subject of significant consultation with industry through the release of two exposed drafts, which were released firstly in August 2011 and then in March 2012. Stakeholders, including the Financial Services Council, the Law Council, Deloitte, considered what the current provisions of the bill have been, significantly enhanced and improved through the consultation period, and now provide more clarity around important technical issues such as the definition of a widely held fund and the operation of the provision designed to deal with FIN 48 rule. This legislation contains two schedules which contain the first two elements of the investment manager regime. Schedule 1 will prescribe the tax treatment of conduit income of widely held foreign funds. The amendment will apply to 2010-11 and for later years. For later years to come. The amendments are designed to ensure that the complex tax issues that can currently arise do not operate to discourage foreign funds from engaging the services of an Australian intermediary, for instance, an investor manager. These amendments will ensure that investment income of a foreign entity is not subject to tax in Australia simply because it engages an Australian advisor, where that income would not otherwise have been an Australian source. Schedule 2 will address the uncertainty surrounding the impact of the United States accounting standards, particularly ASC 740-10, and the amendments are often referred to in that simplicity stage as a FIN 48 measure. The measures will apply to the 2010-11 and earlier income years. The amendments in Schedule 2 remove the potential for uncertainty regarding the Australian taxation treatment of certain foreign fund incomes and will allow foreign investors to move forward in their arrangement with confidence of their Australian position, of their Australian tax position relating to the earlier years. The proposed amendments are designed to clarify taxation treatments of certain income for foreign funds which do not have lodged a tax return or have an assessment made of their income tax liability. Where the condition of the provisions are met, certain types of investment income and gains will be exempt from Australian tax. In addition, losses or outgoings in respect to certain investments will be disregarded. Schedule 1, the investment manager regime, establishes the investment manager regime by allowing income of an overseas-based fund manager to be treated as non-assessable, non-exempt income in Australia where the income is derived from an investment made overseas that has been made through an Australian-based fund manager. For example, and this will hopefully make this a lot more clear. An example would be like a Singaporean-based fund that wishes to make an investment in a portfolio, say in a Japanese bond. The fund would like to engage, say, an Australian-based specialist firm, fund manager with specific expertise in the Japanese bond market. Historically, that would have been prohibited from a tax perspective. This piece of legislation goes to set that so we can open up opportunities for some of our fund managers to play a role in facilitating some of those trades. Currently, the Singaporean-based fund would be considered to have a permanent Australian establishment solely because it was using an Australian-based fund manager, and any income from this investment arrangement, known as conduit income, would therefore be subject to Australian tax. This tax outcome hinders Australian funds managers from competing in international markets. The changes in this bill will ensure that overseas-based funds do not consider to have permanent Australian establishment solely because it's engaged in an Australian funds manager to manage its portfolio in the conduit income that would not normally be subject to Australian tax rules. Therefore, these measures would allow Australian-based fund managers to compete more effectively for investment mandates from overseas-based manager funds. The Australian-based fund manager would still be liable for the Australian tax on the fee and the other income it derived from the arrangement of the overseas-based fund would be liable for the Australian tax on any investment that it makes here in Australia, but not the latter. The bill also contains integral measures to ensure that Australian residents and investors cannot avoid tax by investing in overseas-based funds. Schedule 1 would apply from 2010-11 income year onwards to reflect the date of which the government first announced it would implement this measure. More particularly about Schedule 2, FIN 48, the measure in Schedule 2 are designed to address the consequences of the United States Financial Accounting Standard Board's interpretation number 48, accounting for uncertainty in income taxes, or more simply, FIN 48. The need for these measures arose from Australian self-assessment tax system, where not all tax positions are formally approved by the Australian Taxation Office. The self-assessment system meant that entities would have to make an accounting provision or tax even though no tax was to be paid to the ATO. FIN 48 has a particular impact on overseas funds, which the United States reporting requirements which have a presence in Australia or derive income that could have been considered to have an Australian source. As the tax treatment of the income of these overseas funds is not formally approved by the ATO, it may be subject to an appeal from the ATO, the measure in the Schedule 1 of this bill addresses the issue prospectively. Initially, the FIN 48 rule applies to only the United States public companies, but since December 2009 they've also applied to private entities that prepare US accounts, including many overseas-based management funds. The measure in Schedule 2 would apply to income of overseas-based funds that would otherwise be an assessable income of that fund only where the fund has not lodged an income tax return here in Australia and where the Commissioner of Taxation has not made an assessment or notified the fund of an audit or review. In these cases, the changes would ensure that the income of overseas-based funds would be treated as non-assessable, non-exempt income. The measure applies for the 2010-11 year and previous years to provide retrospective protection and certainty to taxpayers. Mr Deputy Speaker, in conclusion, I support this bill, which establishes an interim investment manager regime because it will help facilitate Australia's world-class financial services industry to grow and to export their services to overseas investors, especially into the Asian Pacific region, which is definitely a growth area for this nation. The measures in this bill have long-term positive revenue impacts as they will result in Australian-based funds managers attracting more investment mandates from overseas-based funds that are currently not utilising Australian firms due to the uncertainty of current taxation arrangements. These Australian firms would therefore earn more fees, increase profitability, pay more tax, potentially employ more people. This is a good measure, and as a consequence, I commend this bill to the House.